All right, so I'm just logging in here to do this live stream. Let me put this on Twitter. So I have nobody's. I can't even tell if anybody's in this room or not. It's the first time I'm doing this. Let's see, I'm going to tuck this in the corner. I got my IB account open here. So somebody just said there's 150 people in this live stream. I can't even tell there's any people in this live stream. So I guess I have no idea what I'm doing, but I'm just gonna go through what I wanted to go through. Give me one sec here. I just want to put the link to this in the Moon Tower Discord too, so people hop on there. So real quick, like this was I got this idea because I wanted to. Sometimes you go you when you're trying to learn something, tutorials like just the right way to do it. You go online, like how do I fix my dishwasher? And somebody's got this video in a row where everything's just lined up already, and they show you how to fix a dishwasher. Um, but I think that there's this other thing that had this idea that um, people would learn pretty good. I think from like what I would call over the shoulder content. I hate the word content, like over the shoulder uh, substance that where if you're watching like the same way you will watch somebody on Twitch on how they play a video game because actually I want to see how are they. You're almost like watching their mind work in real time, or if you're watching somebody learn how to play the guitar or watching somebody learn how to play a song on the guitar, and you watch them figure a song out by ear, but to watch that process in person, like where the person hasn't heard the song before and they're just figuring it out in person, I think you pick up a bunch of stuff that's really interesting from doing that. Like I would want to watch somebody reading a social science paper and then look at the stats at the end of it and break it down. Like where do their eyes go? What's the first thing they look at? How do they think about this? And I want to hear their reasoning out loud. I want to see them make mistakes, like just super raw. So I remember a couple years back, I watched this guy solve this Sudoku on, it was a Sudoku that only had one number filled in. I think it's called like the hardest Sudoku ever or whatever. And this was during COVID, and this guy solves this Sudoku, and it's one of the most delightful YouTube videos that I've ever watched. So anyway, I've always thought that this whole idea of an over the shoulder experience is a bit underdone, or at least that's my guess. So I figured, let me do this. This is totally raw. I have really no real preparation for this. So let me just explain what I want to do. I want to show you, I got my interactive brokers up right here. So I'll make sure Yeah, like I did make sure that the account numbers aren't there or anything like that. So what I actually, the idea that I had was to just to talk about cost to carry in options. It was a topic that came up in the Discord uh, last week. The backstory for it was I had a friend had called me up and asked me to check something out in a name. I won't say what the name was, and I looked at the markets. I was looking at the option markets for them after this was after the close though, so I didn't realize that the bid at that the markets on IB after the close they were super wrong. Like they're not even lined up to where the stock price was. So when I looked at it at first, I said, I need to look at this in the morning because when I'm looking at this, it looks to me like the synthetic futures are 13% over the cash price, over the spot price. So I said, before we do anything, let's make sure that that's not the case. But then in that process, I realized, knowing how to compute a synthetic future was not common knowledge. So I figured let's go through that. And so right here, I just brought up the Tesla options chain, and I'm looking at I pulled up July. We can go with July. So Tesla right now is let's see, it's about 414.70, 414.80, right around there. If we look, something you'll want to do is I look down here at the 420 strike. What I'm looking for is a call and a put that are about the same price, where the call and the put on the strike are about the same price. So here, actually, July doesn't work that well. Let's try this. Let's go to June. Okay, the June 420 call is 66. 10. No, that's not gonna. I don't really like that. I'm trying to find where the call and put are the same, roughly the same price. And there's a $3 wide price differential here. Let's try. You know what? Let's try April. Okay, April works pretty well. Okay, so the April, it's almost exactly the same price here, right? So you got the April 420 calls are 50.70 and the 420 puts are 50.50. And real quick, the stock is 415.50. Here, we can be pretty approximate. 415.50 in the stock. And then the call is 50. We'll say the call and the put are both $50 and 60 cents, with the stock at 415.50. Okay, we're just going to use those numbers. They're close enough to make the point. So what I'm going to do is let's open a spreadsheet. I have to stop this. Sorry, now you got to see my face real big. It's not cool. All right. All right. Okay. So we got, dealing with Tesla. All right. It's, we're looking at the April expiration. So that's 90 days or 91 days to expiry. So we'll say, here, that's PTE 91. We said the call, the 420 call. You know what? Actually, let's do this. Strike 420. The call is 50.60. The put is 50.50. And the stock price was, when we looked at it, it was 415.50. Okay. So, all right, let's look at the situation real quick. So the synthetic future, the way you compute a synthetic future is it's just the call minus the put minus the strike. Okay. So, sorry, it's just the call. Well, it's just the call minus the put, actually plus the strike. I'm sorry, plus the strike. See that? Making mistakes live. Okay. So it's the call minus the put plus the strike. So that is going to be, in this case, the call is a dime. The call minus the put is a dime, right? So the call is 50-60, the put's 50-50. So the call minus the put is a dime. And then the strike was 420. So this is going to give you the price of the synthetic future. So let's write synthetic. Yeah, it's a synthetic future. It's good enough. All right. So the synthetic future is going to be equal to 50-60 minus 50-50 plus strike. Okay, 420.10. Okay, and then the actual stock price. So this is the spot price, and this is the synthetic price. All right. Okay. So question here is, what is the implied? We can figure out an implied interest rate here, right? So what you've got is, I'm just double checking and make sure that these prices do in fact makes sense. Hold on, I'm looking back at the option chain again. Actually, this probably is more like 415.25, not 415.50. Okay. So the synthetic price, but that doesn't change the synthetic price because that only cared about the call, the put, and the strike. Okay. So the synthetic is 420.10. The combo, the thing that we call the combo is the call minus the put. So the combo equals call minus put. Okay. The combo was the combo was a dime, 50-60 minus 50-50. So the combo was a dime. In this case, it's 10 cents, right? Okay. So I want you to think about, there's a trade called a conversion. And a conversion trade is if you sell it's an arbitrage type trade where you would sell the synthetic and you would buy the spot price. So if you imagine doing that, if we sell the synthetic, we collect a dime up front. And what's going to happen is we are short, just to be completely clear, we're short the 420 call. Oh, yeah, I have to tell Excel that you got to put apostrophe there so it doesn't think it's trying to do math. And then you are long the 420 put, and then you're long the stock. This is going to be a conversion trade. Okay. So if you're short the 420 call and you're long the 420 put, at expiration, no matter, by the way, 420 in Tesla, just literally just hitting me how ridiculous that is. Okay. If at expiration, no matter what happens in Tesla stock, you are going to be short Tesla at $420, right? Because if the stock is above 420, you are going to get assigned on your short call. If the stock is below 420, you're going to exercise your put. So no matter what happens at expiration, you're selling the stock at $420. And now you've bought, but you can buy the stock today for $415.25. So if you buy the stock and you sell the synthetic and you collect a dime, you're collecting a dime on the 420 strike, which is why you can think of it as you're selling the synthetic stock at 420 and a dime, because you're collecting a dime and you're going to be selling the stock at 420 in the future. Okay. So in this trade, this is, you're going to make about $5, right? You're going to make $4.85 no matter what, because you're basically selling the future at 420.10 and you're buying the stock for 415 and a quarter. Why is it priced like this? Well, it's priced like this because you have to pay carry on the stock that you actually outlay, the cash you use to buy the stock. And either you're paying in the form of, you're either going to be paying in the form of margin or you're paying an opportunity cost. Okay. So either way, you are paying for that to own that. So that's why the future trade's there. So you can think about how this arbitrage would work. Let's figure out, what we're going to do is we're just going to look at the synthetic price minus the spot price. It's $4.85. So you're going to make, at expiration, you're going to make $4.85 of profit. But what's going to happen in the meantime? So, well, if we take $4.85 of profit, you have to spend today $415 and a quarter to get $4.85 of guaranteed profit in 91 days, right? So if we take $4.85 and divide it by 415 and a quarter, we get, let's turn that into percentage, 1.17%. You're going to make 1.17% of profit over 91 days. So we want to scale that we want to annualize that rather, right? So we're going to take that and we're going to take 1.17% and we're going to multiply that by 365 divided by the 91 days. Okay. And that is the implied annualized rate. Now, so your annualized rate in this case was 4.68%, which sounds right. That sounds like roughly what the risk-free rate is. So you can see here how you could imagine situations where there would be, or you can imagine what an arbitrage would look like. For example, if that call was trading for let's say that call was trading for $52 and the put was trading for $50.50. Okay. Look what happened here. So now you're selling the synthetic at 421.5, right? You're selling the combo is now, I should have made this dynamic. Let's do that. Your combo is call minus put. Okay. That's another noteworthy sell. So in this case, you're selling the combo for $1.50. So remember, at expiration, no matter what happens, you're still selling the stock at $420. You are going to collect the $1.50 up front because you're going to sell the call and buy the put, and that collects $1.50 today. And you're still buying the stock for $4.15 and a quarter. So based on your net cash flows, you are going to make a profit of $6.25 no matter what. Well, $6.25 divided by the spot price of $4.15 and a quarter, which is your expense today, and you get an annual, and that's going to lead to a profit of 1.51%, or at an annualized rate of 6.04%, which you will then pay short-term capital gains on. But that is, you can see how the synthetic future will usually trade. So there's an asymmetry to this. You will almost never see the synthetic trade at a premium to what the prevailing interest rates are. So in this case, when that happens, the arbitrage is to do the conversion trade, which is to short the call, long the put, and long the stock. However, you might see a situation where let's say that the call was $50. You know what? Let's make this more stark. Let's say that call was only $49. Actually, you know what? I don't want to do that. We can leave it at $50, let's say. Here you might say, well, let's say my funding rate is 5%. Like here you might say, you know what, I'd rather than, if my funding rate is 5%, I'd rather buy the synthetic because I'm only paying 4% annualized to hold for that leverage, right? That my cost of leverage here is only 4% instead of borrowing at 5% to buy the stock. So in this case, from your perspective, the synthetic is too cheap relative to the spot price. Arbitraging that could be difficult. Like in this case, somebody to arbitrage that, they would do a reversal trade. A reversal trade is the opposite of a conversion. In a reversal trade, you buy the call, you sell the put, and you short the stock. And the idea there is by doing that trade, the person who shorts the stock to do that arb, they plan to collect interest. So what they're going to do is they're going to pay money. It's like they're going to pay money up front today, but they're going to collect interest over the life of the trade, knowing that at expiration, because remember they are long the call and short the put, they are going to be forced to buy the stock no matter what at 420. So they're going to collect interest in the meantime on the short stock. However, short stock rebates, they vary. They can bounce around. If the stock gets hard to borrow, they're not going to be able to collect as much interest. So it's not necessarily an arbitrage when the synthetic trades too cheap relative to the stock price, or what we say the reversal gets too cheap. If the reversal gets too cheap, that's usually a sign that you're not getting a healthy, you're not getting the full rebate. You're not getting the risk-free rate on the short when you sell the stock. So it's frequently the case that reversals will trade, or that combos will trade at a discount to what you think the synthetic future will trade. And that just means that you're not able to get full borrow. The opposite almost never happens. It's very rare for the synthetic future to trade above the stock price, because that's very easy to arbitrage. You can just buy the stock and short the synthetic. So that was just wanted to kind of walk through how to think about that. But the way in general, if we go back real quick to option chains, we'll go back into I'm going to go back into IB real quick. So you can kind of see if we go out, I haven't even tried this, so I don't know what's going to happen. Let's go way out into the future. We'll go out to June of 2026. And then we see that there we go. So the 430 call, oh, it's even better. We'll stick with the 430s. The 430 call is trading for 108. Their mid market is 100. And I can't believe how tight these markets are. This is very impressive for a call that's out over a year. Anyway, 118.38, and the put is $111. So first of all, notice right away the stock is $413, and your 430 call in June of 2026 is trading $7 more expensive than the 430 put. The out of the money call is trading $7 more expensive than the out of the money put. So this is a very clear example of how much the forward affects these option prices. So again, 430 call, the 430 call is $7 rich to the 430 put. So what's the synthetic future going out into June of 2026, which is 518 days? Well, you take the strike price, 430, Then you just add the combo. Remember, the combo is the call minus the put. The combo is about, we'll call it $7. Call minus put is $7. It's 430 plus 7, 437. So the combo out in June is $437. That's the synthetic future. $437 is, you're talking about, where's the spot price again? 413, $24. So there's a $24 of interest priced into the June 18, the June of 2026 stock price. And does that make sense? Like, just sanity check these numbers. So $424 divided by $413 here. I don't know my calculator. I want to do it with a calculator just to get like as accurate as we can on that. Okay, so we get 24 over 413 and a half. Okay, that's 5.8%, but we want to put that in annual terms, right? So 5.8%. So we need to divide that by 518 days over 365 days. And we get an annualized rate of 4.1%. So you get a 4.1% price or synthetic on the or implied interest rate from now until June of 2026. Now, this is exactly the same kind of math that drives this whole idea of box trades, where you're using the options market for funding. One thing here that to caveat all this is these are American style options, which means that it's actually a bit more complicated than this because of the possibility of exercising early. That means that these options might not exist until expiration because they might become an exercise before they might be an exercise before they expire. For example, if Tesla went to zero, that's like a very obvious case. Like these options would the puts would be exercised at some point early because the put would have a mark to market of $430, in which case you would have to you're tying up that cash. So it would eventually make sense to just exercise the puts. So usually when you do box trades, you're using European style options. So we'll go real quick to do, and this is like, you can actually see how to do this stuff in IB a little bit. I'm just going to go to the SPX chain. Okay. Let me just go out in time just a little bit here. We'll go out to ideally next year. Here, we'll go to next year. And I'm just going to pick I'm going to go to Strategy Builder. And I just want to build a box. So let's go. We're going to do the 4,000, 5,000 box. Okay, just to watch this. So I go to Strategy Builder, and I'm in IB. I'm just going to here click the offer on the 4,000 call because I'm going to be buying that. Sell the bid on the 5,000 call. Okay, and then I'm going to buy the offer on the 5,000 put. And I'm going to go back down here and I'm going to sell the bid on the 4,000 call. Now this is pretty cool because, so first of all, you notice here, IB knows that this is a box. It knows that if I buy, we'll actually look at what this position is. I am long the 4,000 synthetic because I'm long the 4,000 call, and I'm short the 4,000 put, and then I'm short the 5,000 call, and I'm long the 5,000 put. So what does that mean? It means at expiration, no matter what happens, I am buying the SPX index for 4,000. And no matter what at expiration, I'm going to be selling the SPX index at 5,000, which means that no matter what happens at expiration, I make 1,000 points. Now, if I know that I'm going to make 1,000 points at some point or at expiration in 364 days from now, then I must have to pay a lot for that right? Well, it looks like a zero coupon bond. A zero coupon bond is like, hey, you're gonna get paid $1,000 in a year. So it's going to trade at some discount to the $1,000, and that discount will be it's basically an implied interest rate, right? So if we go here, we've created this box, and what you can do is you can hit this button, add to quote panel, and then what I like to do is now it's up here in the quote panel. So now we can see the bid ask on this box. Okay, the box market's very wide here. So it's $935 bid at offered at about almost $980. It's ticking around $935 offered at $980. But let's do this. We'll right click on this guy and we'll go to charts. I'm just going to hit advanced chart. By the way, this is a really neat feature, is that you can always, oh no, it didn't work for this. It works for equities. Okay, well, all right. So I'm going to ignore that for a sec. I'll show you what that looks like in an equity in a second. But let's stick with this. So the box market is, I'm just going to round some numbers here. Let's call it 940 at 980. 940 bid at 980. So mid market is 960. So first of all, this immediately makes sense. You're going to have to pay, if you paid mid, you'd pay $960 for something that is going to be worth $1,000 in 1 year. So that looks exactly like how a zero coupon bond would look. That you would have to pay $960 for something that was going to be worth $1,000 is about a 4% interest rate. It's slightly more than 4% because you're not outlaying $1,000 and getting, for something that's going to 1,040, you're actually only paying $960 for something that's going to be worth 1,000. So the right way to compute your actual return would be 400 over 960, which is going to be a number that's got to be higher than 4%. And this is 364 days to expiry, not 365 days. So there's 1 day of, your annualization there is off by like 130 through 1/365th. So that's another, but that's a good way to look at boxes. Let me go back to Tesla real quick. So first of all, you can go up here. I just hit delete, it goes away. Let me go back to Tesla. I'll just make up we'll look at a December box. And I'm just going to pick a $10 wide box. So we're going to look at the four, make sure I'm a strategy builder. Yeah. So I'm going to buy the 410 call. I'm going to sell the 420 put. I'm going to sell the 410 put, and I'm going to buy the 420 put. Okay, once again, it knows it's a box. We add it to the quote panel. And again, it's a $10 wide box, but the bid ask is very, very wide on it because the implied bid ask is going to be very wide because it's basically the sum of all the market widths on all four of the options. So it's pretty wide. So again, this is a number that, this is assuming this was European settled, you would be guaranteed to get paid $10 at expiration. So you would think that you're going to pay something like $9.50 or $9.60 for this if it was 1 year. I'm looking at a two-year to your option. So it would be more like you'd pay 920-ish for something that was going to be worth 1,000 in 2 years, almost 2 years, 701 days. But let's go here. I'm going to right click on this guy. I'm going to try this again. Charts, advanced chart. This does take a little while to load, but it looks like it is going to load. And look up here. It's pretty cool. It tells you this is the Tesla D26 410 420 box. All right, I've got the plague, so my voice is not exactly right. Yeah, so you can see that the time series is pretty much garbage because it has all these artifacts of wide bid-ask spreads, all being kind of, and all these bid-ask spreads being kind of summed together. So you get a really crap chart, but what you can do is, you know what? Let's actually do this. I was looking at this the other day. I just think that the whole ability to save a structure and then be able to look at the chart for it, I just think is a feature I really like. Here's one I was kind of looking at recently. So a 1 year, this is IBIT. So a 1 year 25, I was actually looking at this. The 25, oh no, sorry. Do not send an order. Hold on. I do not want to do that. Gotta clear that. Discard, yeah. You got to remember, hit strategy builder. Otherwise, you're just about to fire. Okay. Strategy builder. I'm going to go here. I'm going to buy this guy. And I'm going to look at buying the 115 call. So this strangle. Okay. And it, once again, it knows this is a strangle. The 25 put 115 call. And you can add it to the quote panel. You right click on there, charts, and we can see that the strangle has recently firmed. So the strangle looks like vol got, which this makes sense, right? So vol got kind of hammered in the last month in Bitcoin after things kind of calmed down, touched 100,000, and everything kind of calmed down. But it's off at that strangle's off its lows. The strangle market's kind of wide. You can see it's not that bad. It's 576 offered at 604. So first of all, what is that? How do you even think about that? Like 576 offered at 604. So mid market is basically 585. Well, one way to contextualize this, to say, okay, well, the 115 call has, by the way, this is helpful. This is what my IB, this is how actually I organized my IB. With exactly this column layout. So this is my preferred column layout where I have the option open interests over here. And then I have the market information for each one kind of color coded like this. So you got the bid size, bid, mid, ask, the ask and the ask size. Then you can see the volume on the day, last sale. It's probably unnecessary to have a column for days to expiry because it or especially not to duplicate it because it says it right here on this tab. So I'm squandering real estate. You have I like to know what the implied vol on the bid and ask are, and then the mid market. So the mid implied. IV change on the day. I want to know what happened to the strike vol that day. And then I want to know the Greeks. So I had the delta, gamma, vega, and I don't know why there's another last column here. This is just sloppy. The delta, gamma, vega, and theta. By the way, if you ever want to, you can just delete it like that, right? And then Yeah. Okay. Okay. 115 call. The vega of the 115 call is 18.3 cents. Okay. So if vol were to go up from 67.1 by 1 point, these options would go up by 18 cents, 18.3 cents. So these options would go from 468 to 486. Okay. And then the 125 put, sorry, the 25 put has a vega of 6.2 cents. So the strangle vega is 24, it's like 24 and a half cents. So with that market being, look at that width of this market. It's a 28 cent wide market. It's a touch over 1 vol point wide. So it's a 1 vol point wide market in this 1 year, exactly 1 year, strangle. And by the delta of the strangle, by the way, is, so the put's a 5 delta put, and the call delta is going to be much higher than that, I would guess. Yeah. So the call delta is it's 27 delta. And first of all, that might be very surprising to you because the stock is $57. It's only $30 away from the put, and the put is only a 5 delta or 6 delta, and the call is 115, which is more than which is exactly 100% out of the money. It's exactly double the price. And the call delta is 26.8. This is a very good demonstration of that post that I have, the lessons from the 50 delta option. There's two effects going on. The first effect is that, but it's small. The first effect is that the forward is probably about 4% higher than the current stock price, right? So the current stock price, as we saw from Tesla, this is a non-dividend paying stock, this IBIT. So if the stock is $57, 4% is a little over $2. So the forward is over 15, like it's 59 and a half bucks or something like that. So that's the first thing, is like the stock's actually a little higher than you think, but that's a really small effect. I mean, we're still $30, $30 away from the put, and $70 away from or $65 or something from the call. So that's not much of it. Most of this is coming from the fact that in a very high vol name, the 50 delta option occurs well above the at the money strike. That the formula is actually like, it's a function of the forward plus some proportion of the variance. So I have it in the blog article, but so we can actually find it here. So we know the forward out there is somewhere around $59 or higher than $59. Why don't we prove that to ourselves? Let's look at, here we go. Actually, let's look at so the forward is actually 60.10. How do we know that? From what we did before. The 60 call is 14.72 and the 60 put is 14.62. It's a dime. So the synthetic future is 10 cents. The call minus put is a dime. So $60, take the strike price, 60 plus the dime, 60.10 is the synthetic future. So 60.10 over 57.20. So if I just do 60.10, this is exactly 1 year in the future. We're not going to have to annualize anything. 60.10 divided by 57.20. Whoa. Okay. So it's actually 5.07%. So here, that's actually kind of interesting. Like your funding, it's actually a little bit higher than the funding rate than a funding rate. Like there's a small arbitrage in here, right? You could, assuming you could actually trade at mid-market, this probably goes kind of, some of this will go away, like with crossing market widths. But if you could trade mid-market and then you buy the stock, you could make 5.07% doing IBIT conversions. So And that's a little bit of premium there. Maybe that's coming from the fact that in general, funding in Bitcoin tends to trade premium. There's a lot of demand for leverage. It comes from the futures market, but this is fairly easily arbitrageable. Whether you actually think it's worth it to try to make 5.07% minus costs to leg this trade and then pay. Well, actually, this is 365 days, so I guess you would pay long-term capital gain. I'm not exactly sure what happens on the 365th day, but you wouldn't want to pay short-term capital gains on that anyway. So anyway, we once again got to see how you compare the synthetic to the stock price and compute the implied rate. So, but if you look there, the forward is $60, 60.10. Where's the 50 delta option? It's the 75. It's right. It's somewhere in between the 75 strike and the 76 strike, right? There's a 50.3 delta. There's a 49.5. So the 50 delta option in Bitcoin is 25%. The strike is 25% higher than the forward, and even more than 20. It's 28, 29% higher than the spot price. So this is like option theory, right? In real life for you, like you can see that, and then we saw that the strangle. Market was about 1 vol point wide. Actually, if we go back and look at that chart, now we have more context to bring to it, because when we look at the chart, we know that strangle has. Actually, let's pick a date here. We'll go back to the beginning, which Jan 16. So let's go back to December 16. All right, December 16, the price of that strangle was around, call it 930. So the strangle, that's right before the price collapsed, right? So the price of the strangle was 930, and today the price of the strangle, the mid market on the strangle, is 577. Okay, so 930 so this strangle has come in $3.60. Now let's think about attributing that $3.60 a little bit. First of all, that strangle has a positive delta, and since that date, actually don't know. Hold on. I guess you won't be able to see this because I'm kind of IBIT's price exactly a month ago. I was looking it up real quick. IBIT's price is down. Okay, IBIT's price is down $3 in a month. So if we assume the delta of that strangle was about the same a month ago, remember the delta of the call was 26 delta, the put was like 6 delta. We'll call it a 20 delta strangle. So stock's down $3 in 1 month. It's a 20 delta strangle. So that's 60 cents of the strangle. The strangle should have come in 60 cents. Okay, the strangle is actually down. We said $3.60. So there's $3 of the loss of value in the strangle. That is not due to delta. Okay, so of the $3, some of that I didn't. And the reason I didn't want to say is decay is because the theta of that strangle was not $3. Okay, so let's go look at the theta of the strangle. You know what? I just want to try something here by looking at the strangle. There's a way. Sometimes they have something called a profile, where it'll give you. Let's see here. You can on option structures. Sometimes you can open things and it will. Actually, let's click performance profile. Well, It's not exactly what I wanted, but still, it's fine to look at this. So the theta of this thing, that's fine. It tells us the Greeks of it, which is, I'll take it. So the theta is 2 cents. So over the course of 30 days, if the theta was 2 cents during all those days, which it was probably slightly less than that, because a month ago this option had more time to expiration, which means the theta was not as large. But we can say, well, over the course of 30 days, it's decayed 2 cents a day, so that's 60 cents. So that's out of the $3 of non-delta loss of value that we had there. 60 cents of that $3 was theta. That leaves us with $2.40 of additional erosion that has come out of that strangle. Well, $2.40. Well, the vega of this thing is 24 cents. The vega of that thing used to be a little bit higher. A month ago, the vega was a little bit higher. A good test for yourself is, I'll tell you, the vega of that thing was probably it was the square root of 13 over 12 higher. That's how much higher it was. Whatever the square root of 13 divided by 12 is, that's how much higher the vega of that strangle probably was a month ago, if you assume vol was constant. I'll let you guys sort that one out yourselves. So so let's just say that the vega, though, was 24 cents. It's a good enough guess. And the vega of it was probably, if vol was higher, the vega was probably higher, because these are out of the money options. So 24 cents of vega, and this thing has lost $22.40. That is not attributable to delta, not attributable to theta, because we already said that was 60 cents. The remaining $2.40 is vol P&L. So that's 10 vol points. So vol has come in 10 points in a month in Jan 16 of for Jan of 26 in IBIT. So that's kind of decomposing that. And then I think that's enough for today. I just wanted to do this experiment. Hopefully this thing is recording it in case people need to go back and or whatever. But overall, I hope this was helpful, and you just let me know. I'm happy to do more of these if it's actually helpful and stumble over myself and all that jazz. So anyway, thank you very much.